The ability to spot market reversals is one of the most powerful ways to trade. Hello everyone, my name is Marco, and in this video I will show you 3 key technical indicators that you can use to spot market reversals. Now, why are market reversals so powerful? Well, they are so powerful because you're essentially getting at the beginning of a new trend. An old trend has ended, the market has reversed, and you're buying right at the beginning of a massive uptrend, or you're selling right at the beginning of a massive downtrend. So your reward to risk can be extremely high. You can put a tight stop loss and you can squeeze out massive percentages from the markets. That being said, let's jump onto the charts and let me show you the first indicator. So this is my trading view, and we're gonna take a look at the euro dollar on the Vantage charts, and we're gonna look at the daily time frame. I think that is the most popular. Let me tell you a secret. Technical indicators work much better on higher time frames compared to the lower time frames. The lower time frames are filled with noise, breaking news, fundamental events. You can get spikes all over the place, while the daily time frame has really nice and steady trends. So technical indicators have a much higher success rate on, let's say, the daily chart or maybe the 4-hour chart. So let's focus on the daily chart. The first indicator I will talk about is the exponential moving average. You can use just a regular moving average. I use the exponential one. That's just what I'm used to. So what you have to do is go to indicators, search up moving average exponential. Okay, add 2 of them. And then they're gonna be located on the upper left of your screen. You click on settings. The first one needs to be 20, a 20 MA. Second one needs to be 50. This is our 20 MA. This is the 50 MA. So 20 MA is much closer to the recent price action, while the 50 MA is kind of lagging behind. And what you're looking at, or you're looking for, a moving average cross. Here is one, here is one, here is a lot of them. But look at how these two were really good for forecasting a switch from an uptrend into a downtrend, or from a downtrend into an uptrend. So when you have an uptrend and the 20 MA suddenly crosses the 50 MA, you can expect a downtrend. And when you have a downtrend and the 20 MA suddenly crosses the 50 MA to the upside, you're expecting an uptrend. So this is a very good indicator of a market reversal. Now, don't use these indicators on their own because you're gonna get chopped around. So when you're trading, you need to use multiple confluences to get into a trade, right? Because look at this market condition. So it's not perfect. Nothing in trading is perfect. Nothing in trading works 100% of the time. So lots of crosses. That is why it is important to distinguish between a clear uptrend and a clear downtrend and a flat range. This is a super flat range. So in this video, using these 3 indicators that I will teach you, you can combine the 3 indicators and you can get a nice idea of if we are in a flat range, if we are in an uptrend, or if we are in a downtrend. So let's look at these charts some more. Here, 20 crosses the 50, we trend lower a bit. This one is nice. So 20 crosses the 50. Let's say you buy here. Let's say you have many other confluences, many other reasons to buy, but you can have a tight stop loss. And this is what I was saying at the beginning of the video. If you get in at a market reversal, you can have a tight stop loss and you can squeeze out a lot of percentage, right? You can have a really positive reward to risk because you're essentially getting in at the beginning of a new trend. Here we went from this sort of uptrend, crossed, so 20 crosses 50, and then we start a massive downtrend. Let's take a look at this some more. So nothing is really clear here. This is kind of super choppy, but we are steadily kind of grinding lower. Here is a nice one. So you get an uptrend, a pretty large uptrend, and then 20 crosses 50 and you drop and we go down, 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 down. Again, if you had multiple confluences to take a position, multiple reasons to take a position here, a sell position, this would be a very, very nice potential trade. Put your stop loss above these highs, let's say, and aim for a 2-to-1, 3-to-1, something like that. The next indicator I will show you is going to be RSI. So we're back on the euro dollar daily chart. You go to indicators, you type in RSI, Relative Strength Index. It is a very simple indicator. What I like to do is I like to remove this moving average that you have here. So you go to style and you disable the RSI based moving average. And here you have some zones. Usually when this indicator crosses the 70 mark, the price is considered overbought. So a reversal is expected. Or if we go below the 30 mark, okay, see this line, price is considered oversold. And again, a reversal is expected. So you can use this indicator to gauge when the price is overbought or oversold. So this area is kind of neutral, and then here this little area is overbought, this little one is oversold. And when the price is here, you expect the price to go down. When the price is in this area, you expect the price to go up. When the price is here, you expect the markets to pull back at least a little bit, or maybe a complete reversal. Again, indicators should not be used on their own. You should have multiple confluences, multiple reasons to get into a position. But you can use RSI to build a story. So let's check it out. Here, price was in the overbought territory. What happened? We got a pullback. So a nice signal that maybe the buying pressure is gone, or the buying is done. Let's check it out. Here, again, overbought, a little bit of a pullback, not a complete reversal. So again, you're not gonna get 100% accuracy, but you can kind of expect a pullback. When you see the price in this area, you can expect a pullback. Let's see oversold. Here we were oversold, so there was a bit of a pullback, but nothing significant. And here it just didn't work. So let's take a look some more. See the stop? So here is a nice combination. So overbought on the RSI, and then a couple of days later, we get the cross. 20 crossing the 50, and we get a downtrend. So combining two indicators makes your edge even higher. Let's go back a bit more. 15th of April 24. This is a nice one. So oversold right there, and then you get a bounce in the price. Not a big trend, not a big, I mean, it's actually okay. It's actually quite a nice uptrend here. Overbought, you get a pullback. This was a pretty nice one. See right here in the top. This one as well, but then you get a second indication and you get a sell-off. Right there, goes to the extreme, goes to around 26 on the RSI. You get a big bounce. And a combination, look at this. So RSI signals that you should buy. Then you get a cross. 20 crosses the 50, and you get an uptrend. Not a huge one, I'll admit, it's not a big one, but still maybe a 2 to 1, 1.5 to 1. You could get a positive reward to risk on this particular trade. So let's see some more. Here a little bit overbought. Here oversold, this was definitely a nice one. Here as well, you're catching a bit of a bounce, but this one was just, you caught the bottom. And again, combining the cross with the RSI. See? So we go into the oversold territory, we expect a bounce, and then the moving average cross confirms the story. So you get a really nice uptrend. So these are two very simple indicators that you can employ in your trading to spot these market reversals. Now let's go on to the third one. The third one, and the final one for this video, is gonna be a bit tougher to spot. So we're gonna gauge the momentum. We're gonna be looking at how the momentum moves. So I will talk about this a bit later, but first, if you have a Vantage account, you can actually connect it on TradingView and trade directly on TradingView. So let me show you. Again, these are Vantage charts. You go to the trading panel on the bottom, then you find Vantage, so search Vantage, here, click connect, and just log in. So you can log in, you can connect your live account to TradingView, and then you're executing trades right here. So you're doing your charting analysis, you're spotting for market reversals, and you can then immediately place a trade. So makes things very easy, makes things very seamless, and I highly recommend that you guys check out Vantage if you haven't already. And if you have an account with Vantage, I highly recommend you connect it to your TradingView platform. So let's continue. We were talking about shifts in momentum. Now that is also a very, very good way to spot reversals. You're essentially looking for small candles and then a big one that goes in the opposite direction, because usually when a trend is just beginning, you get a massive influx of, in this case, buying and a massive influx of traders. So you get these massive candles. So this is a great example of a reversal on the daily chart. As you can see, we are also painting a picture here. We are collecting different confluences and then spotting these reversals. So we had the moving average cross, we talked about that. We had the oversold condition. Here, price was going into oversold territory. Now I want you to look at the size of the candles. Momentum here is definitely dying down. The sellers no longer have the full control. See, we're becoming a bit flat. But then you have 3 massive blue candles, lots of buying pressure, lots of commitment, and the price then follows that huge uptrend, as you can see. So what I want you to do is measure these candles and see if these candles are far bigger than most candles in the prior price action. I would say that these 2 blue candles are definitely as big as the biggest red candles, maybe even bigger than most of the red candles. That signals a clear shift in momentum, especially when you get consecutive blue candles or consecutive red candles. So you're reading the momentum, you're reading the size of the candles, and this is what it looks like. So price is going down, trending, and then it slows down. Sellers are struggling, sellers are losing control, and then boom, buyers get in, uptrend starts. Here is another great example. So it doesn't have the cross, but RSI oversold. Look at the candles. Look at the size of the candles. Sellers are struggling. The candles are becoming smaller and smaller and smaller and smaller, barely breaking these swing lows, and then you get an explosion to the upside, and then you get an okay uptrend. It's okay, it's not that strong, but it still goes up. So you can time a nice buy setup right after this big blue candle. And just by comparing the size, you can clearly see that this blue candle is far bigger than any of the red candles in the most recent price action. So a bit tougher to spot. You know, a moving average cross is very easy to spot. Anyone can do it. With this sort of an approach, you need some time to look at the charts, to look at the momentum, and to notice when the momentum has shifted. Now, this is a very clear-cut approach. Just look at the size of the blue candle compared to these ones. But there are some slight nuances that you would need to learn in order to fully implement this sort of analysis. It is not hard. It just takes some work, it takes some backtesting. And this is the final example for today. Now, this one does not involve the RSI. Throughout the whole period, RSI was, you can say, in the neutral territory. So it wasn't above the 70 mark, as you can see here. But what did we get? We got a moving average cross that signals a start of a downtrend potentially. And look at the momentum. So you're gauging the momentum. You're seeing the market is struggling to go up. Look at the swing highs. See this one, barely breaks, you get a wick. Barely breaks, you get a wick. Barely breaks, you get a huge wick. That is a sign of weakness. That is the sign that the buyers are exhausted. That is the sign the sellers may start to push the price lower. And also look at how the price action is moving, just correctively struggling to go higher. But again, a key indication for me personally is how weak the breaks of the highs are. No conviction, no follow through, just wicks. Just a clear ascending channel and a clear struggle. So what happens? 2 very nice red candles, 2 consecutive red candles, and that is what I love the most. I love consecutive blue candles or consecutive red candles. Check out the size. So pretty large, pretty significant, bigger than most of the other blue candles, right? and they are one after another. So a clear sign that the sellers may be stepping in, and a clear sign that a sell trade would be high probability in this area. Then in combination with the moving average cross, this becomes even more powerful. So those were the indicators that you can use to spot market reversals. Your job now is to look at the charts, do some backtesting, and see how you can implement these indicators into your own personal trading. My main lesson is don't rely on one indicator to take trades. You need multiple confluences. There is no indicator in the world that has a 100% success rate. Trading is all about the probabilities. If you have a win rate of 60% and a reward to risk of a 1-to-1, you can make money. As long as your win rate is above 50%, in that scenario, you make money. Or if your win rate is 30 to 40%, but your reward to risk is 3-to-1, you can make money as well, because when you make money, you make 3 times more than when you lose. So you have to start thinking in probabilities, and you have to start building a story. You're collecting multiple confluences, you're creating a bias, either a buy, neutral, or sell, and then you're executing on that bias. So thank you very much for watching. Do check out Vantage. Do try and connect Vantage to your TradingView. Have a great rest of your day, and I will see you in the next video.